Hello, my name is Matthew Baration, and this is my session 10 assignment. So for our mission overview for our assignment, we must evaluate Starbucks' proposed flagship roastery that requires a $12 million upfront outlay and expected to operate for 10 years. We must use that firm's 8.5 WACC as a hurdle rate to determine whether the project creates value and to recommend an accept or reject decision supported by this driver of documentation. So before we do anything, we got to list out our project parameters, which they were given to us, which is our initial investment, working capital, revenues, operating costs, and taxes. Once we have those listed out, we can move into our define and discover first step of the driver framework. And here we define and list our parameters in which our initial investment is sitting at $12 million. The appreciation period is at 10 years. Our working capital initial is at $500,000 with our working capital cover year sitting at 10. Our WACC is at 0.085 with a tax rate being at 0.25, so 25%. Our terminal value is sitting at, I can't really see the zeros that well. My eyes are kind of bad. I think it says 3 million. And our project life is sitting at 10. So here we've listed out our revenues for year 1, 2, 5, and 6. Along with our COGS rate, our labor costs, our potential rent utilities, and as well as our marketing year 1, the marketing thereafter, be the following year. And here we created a list where we want to list out the metrics that we need to calculate and our sensitivity scenarios. So now we have all these defined and listed. We can move on to represent, which is actually outlining this model structure and defining these variables. Not defining them, but creating a definition function form. So here first we created, the function for the calculating the cash flow schedule, which we included all these different variables within here. Our goal here is to calculate this incremental cash flow for the project, in which we initialize the data frame for the cash flow schedule. So after we've done that, we move on and then we can define the calculation of the NPV, net present value, using our WACC and our cash flows. And after that's been done, we move on to calculating the IRR, which is, we use our cash flows for. So after we've outlined the model and got it set up, now we can begin implementing and actually calculating the cash flow schedule using the model that we outlined. So we move on and look at the code. We import pandas. Again, same thing, calculate cash flow schedule. Move on here, we do our annual depreciation, which we calculate throughout the years from 0 all the way up to the year we need to. Here we have listed out, in a for loop where we have our revenue, COGS, gross profit, operating costs, depreciation, EBIT, our taxes, net operating profit after our taxes, and also working capital change and net CapEx for intermediate years, as well as a free cash flow before those adjustments. After we got those listed, we have our year project life, which are working capital recovery and terminal value, and then after that we can set our non-applicable cash flow components to 0. Within that year 0, we want to round it and keep the 2 decimal places and call the functions to have it spit out our base cash flow schedule generation, which can be seen here. So next in this is our implementation stage where we calculate the financial metrics of this model, in which we calculate NPV, net present value, IRR, discounted payback period, our simple payback period, and a profitability index using those generated cash flows that we had done. So in this, we want to install NumPy Financial first, just to make it easier. Again, we call the same function of the calculation of the NPV using the WACC and our cash flows, as well as the IRR. And the only difference here now is we're defining that calculation of the simple payback period using the cash flows and our initial investments. In addition, like I said earlier, calculation of discounted payback period with the WACC and cash flows. Initial investment is included here, with a cumulative discounted cash flow playing a factor as well. Moving on to the next thing would be our calculated profitability index using, again, WACC and cash flows. So at the end of all this, after we've actually calculated these metrics, we sit with a base case and net present value of a little bit over 3 million, a base case IRR of 13.25%, and a simple payback period of 5.28 years, and a discounted payback period of 8.21 years, and a profitability index of 1.24. So after this, we conduct our sensitivity analysis that was required of us from the driver textbook. And through this, we just want to run our analysis using our parameters that we had previously defined and listed. And first, we want to run the cash flows, schedule and calculate the MPV and IR for a given scenario, which we call all the, the calculated cash flow schedule, extract that free cash flow, call our MPV, our calculated NPV and calculated IRR, return, our newly calculated NPV and IRR and initialize the empty dictionary for our results. And this is where we have our sensitivity analysis, where we actually have the revenue reduced by 20%, and we'll see what happens. Another thing would be the minus 0.2 or 2% of the WACC. Another scenario we had was increasing the WACC by 2%. And in here with our different scenarios, for that first scenario of revenue being reduced by 20%, our NPV is sitting at negative 3.1516 million, give or take. Our IR is sitting at 3.19%. With our second scenario of the WACC being reduced by 2%, sitting at 6.5%. Our NPV goes up to 4.6% or 4.6 million, with our IR also going up to 13.25%, pretty big jump. With that third scenario of our WACC being plus 2%, so sitting at 10.5%, our NPV actually goes down to 1.6 million, give or take, with the IRR sitting again at 13.25%. So after we've done all that, we can begin validating our procedure, in which we calculate the annual depreciation for verification, and we want to verify the revenue and COGS for the cost of goods sold for year 5, as well as our depreciation for year 5 needs to be verified. So after that, we can print out a summary and take a look at it. So you see with the verification for the year 5 revenue, our expected was 11 million and our actual was 11 million. For year 5 cost of goods sold, expected was 4.4 million and the actual was 4.4 million. And again, with the year 5 depreciation, our expected was 1.2 million and then our actual was 1.2 million. So because these validations are passed, we can assume that these cash flows, the cash flow schedule is consistent with our expectations. So after that, we can move on to our evolve stage. In this, we have our current financial model, operating with fixed parameters. However, there are a few different options that we can use to explore to create a more sound and better overall model. So with this, one of them will be a dynamic marketing cost adjustments. So for example, instead of fixed marketing costs after year 1, we can implement a more dynamic approach. For example, being at a K rate or tiered spending based on revenue growth to create a more real world scenario model. The next thing would be incorporating inflation into this to make it, again, a more real world applicable scenario model. The next would be a probabilistic outcome, so something like a Monte Carlo simulation, where we move beyond point estimates by implementing that simulation and defining. And this would include things like defining a probability distributions for our key variables and running a bunch of simulations to generate possible random values at NPVs and IRs to get a more whole look at it with multiple simulations, then go on the average of those simulations. Next thing would increase the expansion of our sensitivity analysis and include or combine, more variables within there. The more parameters, usually the better the model will be. Not always, but it can be something that'd be worth exploring if that was our goal, was to create a more sound model. Finally, we move on to our 6th step in the driver framework, which is just a reflection period. In this, I include a little summary. So based on our financials, the Starbucks flagship roastery project is actually recommended under our assumptions after going through this model, because it yields a net present value that is positive, an internal rate of return which is above the WACC, and a good profitability index. However, it is sensitive to revenue fluctuations becoming unprofitable if revenue decreases by 20%. So in this, we can go down to our insights and next steps. I just wanted to list out here the key data analysis findings, just to have them listed and reiterated. The last thing actually, would be insights or potential next steps with this reflection. So these metrics are actually favorable. The project's high sensitivity to revenue suggests a need for more robust market search and strategic plan to reduce revenue-related risks. So again, things such as I honestly would suggest doing a Monte Carlo simulation to get a better understanding of how these simulations work, to get a more, I guess, just sound more fitting, better fitting model. Then instead of going off of one simulation, one prediction, it'd be better to have a bunch of simulations and then use that as our base. But yeah, that's my assignment.